Hi, I'm Harry Dent, founder of the H.S. Dent Foundation. Our mission is helping people understand change, and boy, do we need that right now. I think a lot of people are very confused. Even the smartest people on Wall Street don't fully understand what's happening in this stock crash we've seen here recently. But we step back and tell people, look, we look at long-term cycles, things that are very predictable, like how much people spend in money and earn an income and borrow for houses and buy houses as they age. And since 20 years ago, we've been saying this baby boom would continue to rise, and around the end of this decade, we would see a downturn, a long-term downturn, much like the downturn in Japan that we forecast in the late 80s for the 90s and early 2000s. So there's a method to this madness, and what we really have here, two important cycles that we study long-term. And we study a lot of cycles, but here I'm just going to focus on the two important that are creating what we call the perfect storm, this 40-year generation cycle. And note, like a clock, every 40 years our stock market has peaked, 1929, 1968, and now between late 2007 and perhaps late in 2009, long-term peaks. And what's important about those peaks, when the stock market peaked in 1929, stocks did not get back to that level until 1953, 24 years later. Same thing after the 68 peak. It was 25 years later. So when most people tell you, well, just hang in for the long term and asset allocation and be diversified, you'll be okay, not when you see a peak of this magnitude. Bubble booms like this only occur every other generation, every 80 years. So this is a once-in-a-lifetime thing where we see a bubble boom on a 40-year generation cycle peak and then have to go down, and all the bubbles in that boom, real estate, stocks, and now commodities, have to deflate. The banking system lends against all those assets, especially real estate, and therefore the banking system gets overwhelmed, just like it did in the 30s. Now, that happened a little bit in the 1990s, but the 30s was the real thing. So now the second cycle is equally important, and it doesn't usually concur with this demographic cycle. Commodities and oil prices peak like a clock every 29 to 30 years. 1920, 1951, 1980, and now, although some people think oil peaked in the middle of 2008 at $147 a barrel, our cycles much more strongly suggest that oil will go much higher into late 2009 to mid-2010. Now, this also matches up with another simple set of logic. In modern times, particularly since the Great Depression, but particularly in the 70s and 80s and 90s, when we go into a downturn, the government responds predictably. The Fed lowers interest rates, and fiscal policies are designed to stimulate the economy. So, for example, when the last long boom peaked in '68, we went into a recession in 1970, a pretty darn deep recession. The government stimulated us out of it. We come out of it in 71, 72, and back into a deeper recession and a bigger stock crash, 1973 to 74, and that recession lasted into 75. In 1980, now this is important because this happens when the commodity bubble peaked, the last commodity bubble. Oil prices peaked in early to mid-1980 at $40 a barrel, which would be like 100-some now, but enough to hurt the economy seriously back then with other trends. The economy went down. There was a first stock crash in 1980, then a rebound from government stimulus, and then a second stock crash from 81 to 82, and the deepest recession and highest unemployment we've seen since the Great Depression. So it's another thing to understand. What we try to tell people here, you're getting in 2008 and forward well into 2009 at first, a glimpse of what's going to happen. This is what we call the appetizer, the first course. You're seeing the economy get worse, you're seeing the subprime crisis, you're seeing banks failing, and you're seeing a whole worldwide system shake out because of this. Well, what we see is this and much more in the second cycle. Government stimulus tends to have about a one-year lag. So all this stimulus in mid to late 2008, which will continue in early 2009 with the $700 billion Treasury plan, will hit the economy at its peak in the late 2009, early maybe mid-2010. So this goes very well with this commodity cycle. We come out of this recession by, say, mid-2009, and We see interest rates march back up because inflation's already at 5% in this recession, and if it's 5 or 6% when we come out, bond rates are going to go up dramatically. That will kill any housing recovery on a lag. And oil very easily went up to 147, even when the economy was already slowing in 2008. So we get a rebound. We see oil going to something like, just a very good guess, $215 a barrel. Maybe a little lower, maybe higher, or maybe if the economy does not come out of this as strong as we hope, maybe it just goes back to its highs. But we see this commodity bubble yet to peak. That next peak will trigger another stock crash, and this time the baby boomers are set to slow down. See, the big thing, we've been predicting that the housing boom would peak because spending on housing and demographics peaks in the late 30s, early 40s, several years ahead of overall spending peaking in the mid to late 40s. In the roaring 20s, housing peaked in 1925, started to fall, but then really crashed from 30 to 33 when the broader economy went down. So that's what we've been looking for. The first slowdown in housing, as we've seen here, in fact, it's been a little stronger than we expected with the subprime crisis, a little bit of reprieve and rebound in 2009, then the stronger downturn. Triggered first by oil prices and commodity prices, but it's the baby boomers who finally slow down in spending. They're holding our economy up in this crisis. They're still in the last few years of their spending cycle. Again, we've been predicting this since the late 80s. The boom that started in 1983 would last into 2008 or 9, basically just by lagging forward the peak in spending of the average household, about 48 today, for the birth index adjusted for immigration. So again, what we use and what we'd like you to learn more about at our website or in any way studying our books and special reports, we use demographics to predict all types of things. Even inflation is more driven by demographics than any other trend. Migration around this country is not driven by retirees, young families looking for jobs. It is totally demographically driven. We study all those trends as well.